The good thing about shitcoins is they can go down 90% after they've gone down 90%. So they can keep going down. Like there's no fundamentals to drive this business up.
Hi, everyone, and welcome to a new episode of the VC React podcast. Every week, we bring you insights and reactions from top VCs, LPs, and angel investors reacting to the latest news on startups, VCs, and investment rounds. Let's jump into it with our amazing guests for today. Ghandour, partner at Wamda Capital. Saad Hasan, principal at Sturgeon Capital. Tambi Jalouqa, founder and general partner at Maza Ventures. And my co-host, Jamie Lane from FWDstart. In the video description, you will find more details on our guests, their LinkedIn profiles, and links to their companies' websites. Our weekly news are brought to you by FWDstart, a twice-weekly newsletter that breaks down what's happening in the MENA startup, VC, and tech space. Before we start talking about the news of the week, I want to tell you about Octa, our new sponsor. Octa is an AI-powered workflow automation platform that helps modern businesses collect payments faster, smarter, and without the back and forth. If you're a founder or a finance leader, you know that managing receivables requires 14 hours plus every single week. It's chasing corrections, negotiating payment terms, updating invoice details, and constantly following up with your clients.
Octa automates the entire process, handling everything from invoice disputes to payment confirmations, so your team can focus on growth, not admin work. That's why more than 100 companies like Careem, Lean Technologies, and Algram trust Octa to streamline accounts receivable. Check out Octa at weareocta.com. That's weareocta.com and experience the modern way to manage receivables.
Jamie, what's happening this week?
Yes, so noted Jordanian VC Tambi Jalouqa has launched a new VC fund. And sorry for putting you on the spot. I know we were talking about this off before recording, Tambi, but obviously congratulations on that.
Oh wow! Look at the rockets from
that was cool. That was very cool. And look, tell us more about it.
Thank you, Jamie. I wasn't planning this, but yeah,
I'm putting you on the spot.
I have to. So it's just continuing the mission of backing people at the early stages that are doing things that are not usual. I know that software usually sounds like that, but in our region, it's really hard to back a software company and take it places. Lack of funding, experience, a lot of things. So continuing to do that, this time as a solo GP, which is also controversial a little bit. But I believe it's going to be a good fund. It's a good firm. Hopefully, I just launched, so things are going to start taking shape slowly. Planning to do the first close soon. I'm not going to commit to a date, but really soon, so I can continue investing. And yeah, I think there are so many talented people in the region. We were focusing before that on Jordan and Saudi. Now it's the MENA region as a whole. Maybe Saad will pull me even further away towards the Caucasus. Let's see. But yeah, it's just investing in software startups with a high focus on MENA.
That's amazing. And congratulations. And it's super exciting. And congrats as well, Saad. I believe Sturgeon closed the second close of their second fund as well. I think at some point over the last couple of weeks. Would I be correct in thinking that?
Yeah, no, it was just a few weeks ago. We kind of got like confirmations done and everything like that. You know the whole LP agreement sort of they get signed and sort of capital calls go in and we go like, here, we've done the second close now. So we're very proud to have Kazakhstan Investment Corporation join the ranks as the anchor in the second close. And just for background, we are a sector agnostic early stage fund investing across Pakistan, Bangladesh, the Caucasus, and Central Asia, along with also investing in companies that can foundationally build into the MENA region and adjacent regions as well. And so, yeah, I'm super excited to sort of back some great founders through the second close as well. We've already made like around 10 investments. So we're kind of in the tail end of sort of potentially the investing in deployment stage, but generally, we're very excited about what we can do with this $30 million target fund.
Awesome.
Saad, can you tell us about the fish behind you?
Yeah, of course. And a sturgeon is a prehistoric almost fish that is millions of years old. It is foundationally representative of persistence, quality, because it yields caviar. And we were talking before, it was between this and cockroach capital. So I think it kind of, uh, I'm pretty glad that I don't have to explain cockroach capital.
Okay, thank you, Saad. Cyrus, do you want to talk about the background behind you?
It's the summer's coming up, and I think that watermelons are staple for summer. Also a symbol of a free Palestine.
Okay, amazing.
And depending on where you, how free you're able to express yourself. But I enjoy watermelons, and I think it's a symbol we need to all carry to, lest we forget what our real mission is. At least I speak for myself personally. So
I am Palestinian, Jordanian American. I feel you. Free Palestine. Jamie, back to you. What are we discussing this week?
Sorry, massive detour there, but yeah, let's get into it. A very worthy one. Yeah, let's talk about Jordanian EdTech company first. And I was really happy to see this last week. I think it's fantastic. So Seesaw, I don't have any children, but my fiance is a teacher, so I'm very familiar with Seesaw as a platform. I'm sure if you have kids, you might be familiar with Seesaw as well, as the kind of go-to platform, which you either bother your teacher on or your teacher bothers you. I'm not entirely sure how that works. But they're US-based, it's a K-12 learning platform. So they've acquired Little Thinking Minds, Jordan-based startup focused on Arabic literacy. In terms of the deal itself, weren't disclosed, but the integration seems pretty significant. And they're going to use Little Thinking Minds curriculum and assessment tool to build its own Arabic language platform that I think is set to launch in 2026. Some context and background on Little Thinking Minds, founded back in 2004 by Lamia Taba and Rama Kiali. Over the last decade, it's really established itself as one of the preeminent EdTech companies in the region as well. It's worked with over 3,000 schools, ministries. Some of its notable platforms, I think I Read Arabic, I Start Arabic, and Mizan supported more than 400,000 students over that time as well, which is amazing. I think the last funding round they raised was back in 2018. Was a Series A led by Algebra Ventures, Mindshift Capital, ISSF, Turkey Ventures as well. Had early backing as well from Oasis 500. So look, for Seesaw, obviously the acquisition makes a lot of sense in terms of them being able to obviously co-opt that sizable existing user base in terms of them entering the region, and the platform's already used by over 10 million users globally as well. So it's interesting. And I think it's great for EdTech as well, which traditionally I think is one of those things where it's difficult to see an exit sometimes.
Yeah, I'm sure our friends at Fikr Ventures, Mohammed Khawaja, is so happy for this acquisition.
By the way, I think EdTech might be slow growth usually, but it's a very sticky product. I do see why venture capital and private equity fit, and it's usually, as at least the ones in Jordan and the ones I know, private equity are usually targeting EdTech companies, software or physical spaces. So I think it just makes sense. And yeah, Seesaw, I think, is gaining product and market share. And they're establishing themselves in the Middle East and also have more Arabic focused products to offer through the acquisition. I think it's a good.
Do you think that's what triggered the acquisition, Tambi? The Arabic or local content, or it's the user base and something else?
I'm going to say both, but more the product. In my opinion, I don't know. Okay, I do know a few people that work there, but I don't think that at the Seesaw level, I think they are opening up and having more stable grounds in the region. And already a lot of people use them, but now they can use them for more things, more products. So even the Arabic education, even the early STEM things that Little Thinking Minds offers.
Yeah.
Saad, what do you think? How is EdTech in your region?
Yeah, I think in terms of EdTech, it's fundamentally like an omni-channel business. There has to be like fundamentally a lot of different touch points that you have to sort of capture in order to really build a sticky experience, and sort of, because you're going to naturally have a lot of churn as people go through sort of grades and graduate and everything like that. But of course, there's like a very large and long tail market of like referrals and like sort of families and households that may end up using your product over generations. And that's sort of the potential that EdTech holds. However, I think it's still also something which may not be, which is a great business if you can bootstrap it to sort of like Series A or something like that, and then really then go for a big round and potentially then scale it. And then like once you can get some PE money in there, middle market or something, then you can really sort of turn on the afterburners. And that's why PE firms love it, because it has an immediate ROI in terms of capital deployment within the business as well. But beyond that, I think if you look at Seesaw, they definitely are looking at globally expanding into different school systems and different sort of geographies and that kind of. And I think we shouldn't underestimate like the amount of groundwork that an Arabic learning platform would have already effectively done around sort of partnering with some of these like Arabic curricula school systems, which Seesaw definitely wants to target and sort of get into their core sort of business sort of development operations as well. So both on a product level and as well on a business development level, it makes a lot of sense. I think I was reading the article, the guys who originated the transaction, BD&T partners, I believe, or something like that. They might be getting a lot of calls for sure in terms of from EdTechs around the region.
Yeah, and Saad, at Sturgeon Capital, you mentioned that you have, I think, 10 portfolio companies. Was any of them EdTech?
Yeah, we actually have we have one of the leading EdTechs in Bangladesh called Shiko. It's backed by Learn as well and Wavemaker, and they've done a very, very good job in terms of growing into profitability, really sort of customizing the curriculum, and then again, sort of having like an omni-channel approach where they have focused on effectively being almost everywhere. So EdTech, like most commerce-based service businesses, it's all about traffic. And if you can generate traffic at the end of the day through multiple sources, even if you have lower conversion rates, you will have good enough AOVs and good enough payment behavior to effectively sort of really make a good amount of cash. Even if it's not recurring revenue, I would say it's still revenue that has a good sort of operating leverage behind it, because the baseline costs are actually pretty low.
Faris, in general, what do you think about EdTech in MENA and your first reactions to the acquisition news?
My former GP and I, Khalid Talhouni, we gave a talk in 2015 at one of the 500 startups events in Bahrain. And the thesis was, or the general thinking was, your first wave of startups, let's say scale-ups that will generate successful returns, is going to be e-commerce, anything around discretionary consumer spending. So, and that was the natural way. Then the natural evolution to that is going to be enabling easier ways to facilitate e-commerce. So say fintech, and that has played out. The last two waves that I think that will play out are going to be healthcare and education. And I'm not saying that because of a bottom-up kind of exercise where you're finding the founders there and you're starting to get traction. It's more of a top-down, just the percent of GDP spend, right? And healthcare and education are just absolutely massive to any economy, and they're central to any economy's development. So from a top-down level, whether or not I'm kind of, let's say, bullish education or education tech or what have you in the MENA region now, I think timing it is difficult. It's not as difficult to say if this is the right time or not, but I have zero doubt that the next wave of unicorns you're going to see after the fintech wave is going to be in healthcare and education. So that's just generally on my view on education. You're already seeing work, you're already seeing Abwab heading towards that, and maybe a couple of others heading towards, inshallah, unicorn status at some point. They have substantial revenues, cross-border. Iraq is a big market where that's materializing as well for some of those startups. In terms of our investments, I mean, none of the EdTech ones, let's say, have necessarily I mean, they're doing great, but none of them have I forget who was it, Tambi or Saad mentioned that, they're not kind of hyperscalers or hyper growth type of entities, which has been, the case with our investments as well. So expecting kind of hyper growth is a bit of a challenge. I think naturally speaking, the thing I like about education, and as a family business, we run a couple of gyms as well. One of our family businesses is a gym in the UAE, and our largest customers are kids between the ages of 6 months to 18 years old. And we have about 4,000 kids doing all kinds of different activities. Parents are very picky, and but when parents find something they like, they'll spend. They'll cut every other budget item before cutting any spend on their kids' well-being and education. So these products may not be sticky in the sense of, kids graduate, they evolve, they go to college, but they're sticky in the sense of trust in the brand. And I suspect that that's the key component to what Little Thinking Minds managed to do, is build trust at the brand level, where the parents, I don't think it's about the market share they have necessarily or the number of parents they have. My hunch tells me this is about the brand equity Little Thinking Minds has with parents. And that being a means to a distribution strategy that, the acquirer Seesaw is looking for. So I suspect that the consideration taken into account by Seesaw is brand equity among parents, which translates to retention and translates to cross-selling different products. Second is price, value for money. Is this a deal that's going to cost them an arm and a leg? And I suspect that it's probably not a deal that cost them an arm and a leg. I'm sure the investors made handsome returns, but probably didn't also cost Seesaw an arm and a leg in terms of, this is an acquisition that was one they had to dish out a lot of cash for. So I think that's probably the second consideration. And third, naturally, is entry to the Middle Eastern market. And there's really not that many acquisition targets. So just by process of elimination, if I'm following that logic, probably Little Thinking Minds is one of the few that comes up. Solid, good team. They're good people on a personal level, so I know them. Persistent. They stuck around and they kept building, right? They have that resilient mindset, and I think that translated into success. My question when it comes to EdTech, from what I've seen, is I'm a believer that content is not a product to monetize. I believe that content is a good means to build a brand, good means to build acquisition, to reduce the cost of acquisition, because you're inherently driving value to whoever's consuming the content. But you're leaving money on the table if you're trying to monetize content, because that's another way, in my view, of saying you're trying to monetize the brand without actually having a product. And we've seen that play out with a number of these, let's say, like multi-channel networks and whatnot, where they're started by content creators with little interest in expanding beyond that or know-how. And I just give a basic back of the envelope example. It might not be the smartest one, but like if you look at Mr. Beast makes his money off the product he sells, not the content he creates, right? I mean, he makes a ton of money off of everything. But really, Mr. Beast is an e-commerce machine. That's fundamental. He sells his burgers, he sells his chocolates, he sells other stuff. His TV shows as well, which are massive distribution. So I generally tend to think that taking content businesses to the next, and I have experience having built Tuhun, which is a mental health startup. It's similar to Calm and Headspace, self-help. We've got 300,000 users, and you'd think that means we make millions of dollars. It doesn't. We make our money from B2B, not from the number of users we have and not from the content that we have. If you look at, a podcast platform in Saudi, Thamania, these guys make good money, and they're the largest by far podcast network in the Arab world, but they don't monetize the content per se. The brand equity and brand awareness in the market compared to any other e-commerce brand, Thamania is probably way more known than most other e-commerce brands. E-commerce brands make hundreds of millions of dollars in revenue because they're selling a widget. So I think translating content into a widget and something to monetize as a widget is the natural evolution that I would want to look for in EdTech and in an EdTech founding team for me to say, yes, I have conviction in backing this startup. So maybe that was a long-winded answer to just tell you more about my views on EdTech. But no, I don't have a more sophisticated view on how to go about that exercise.
I'm really happy that you mentioned content, because I had in one of my questions for CISO, as Jamie mentioned, they have 10 million users worldwide. And it seems for Little Thinking Minds, they have less than 500,000, which is like less than 5% of CISO's number of users. Does it justify an acquisition if it's a content play? And it's not, as Faris mentioned, but if it is, they can localize the content using AI today, right? And I've seen EdTech companies utilizing AI to go through all of the curriculums in almost every single country, so that they don't have to hire a huge team to do all that, customize their platforms to fit the curriculums of private schools and public schools everywhere. I don't think it's a big acquisition. In total, it seems Little Thinking Minds, they raised $2 million funding over 20 or 21 years. And CISO raised more than $175 million. So it's a very small acquisition. And I still think or question, why did they acquire this company? It's not a content play. It's not the users. Is it just a brand?
I think it's sorry, just to quickly add, I think it's my view is it's two things. One is most likely it's not a cash exit. I haven't looked into it. It's probably there may be some cash in there, but it's probably not a cash exit, you know. Certainly there's more upside to be had for the founders, I would imagine, if they stick around. Content is great, but you know, they say the age-old kind of saying, you know, content is king, distribution is queen. You can have all the content you want via AI, but if you don't have distribution, good luck. 500,000 users isn't insignificant. It's not, let's say, substantial. It's not insignificant. I want to look at the consumption behavior of their power users. But I think also let's not underestimate one important thing. A lot of these global scale-ups are looking to raise from the sovereign wealth funds in the region. And the sovereign wealth funds in the region tend to want to have entities that have some form of an operation on the ground or have expressed interest in delivering value to their domestic markets. And I think that might be one angle. Is like, okay, yes, I don't know, I'm saying, like, let's pay $10 million for this company called Little Thinking Minds. And, you know, if that manages to unlock an order of magnitude larger than that in capital from the sovereigns, then that's like paying a finder's fee almost, right? Like you pay around that much, you know, 5, maybe up to 10% if the person sourcing your capital is good, like an advisor, you're paying that much. So you could think of that to a certain extent as potential. I don't know. My hunch tells me it's probably associated with this entity's, you know, CISO's interest in raising capital from the sovereigns in the region and wanting to show good faith by showing that they have presence in the market and paying equity for it. And we all know equity is very cheap until you go public or you have an exit liquidity event when equity actually has a dollar value associated to it.
I would actually add, like, so the way I kind of look at content is that it's a cataloging play. So think about movies, think about sort of having effectively. So if you look at sort of Seesaw, they've got like a ton of catalogs that they partner with. So having effectively a catalog that they can fundamentally sort of buy allows them at least to understand that even if it doesn't quite work out with like the team integration dynamics, they have something or the other of value that they can sell in a few years. The other thing is, I think 500,000 people is a significant number of users to have tested the content on. And I think a lot of people forget that, yes, AI can generate content, but then you also have to build AI to understand the response to content in EdTech. So where's the breakage point, for example, between the learning experiences and the learning outcomes in that sort of content journey as well? So if you have that primary source data, that can be actually very valuable when you actually think about sort of developing like high performing content. So like Faris said, Mr. Beast does well because he has very high quality content, right? Everyone can make content. I think my dad can make a few vlogs and put them on the internet. They're not really going to get any level of traction, but the production quality has to be there.
Yeah.
But beyond that, I think it's also don't underestimate B2G contracts. Like there could be fundamentally, this may be a tender requirement to have effectively a Arabic learning module in FIFA. So like it might just be as simple as fulfilling that versus anything more interesting.
Yeah, that's a actually I didn't think that's a very good point.
Tambi, what do you think? Is it the content, the users, the government contracts, the capital from sovereign wealth fund, or something else? Or maybe the connections to 800 schools? I don't know.
I agree with Saad and Faris. It's probably not only the revenue, probably strategic and more aligned with, having someone who was already on the ground doing this for the last 20 years. Don't forget, as everyone said, governments enjoy working with the thinking minds and they have that connection. Some people grew up on the thinking minds. Maybe some employees actually were using it when they were at school. Imagine how much time passed. So I think that those solid connections with governments, with schools, give them something that they cannot build very fast, even if they generate content using AI or if they spend on marketing. I agree with Far. It's a very affordable way to get into the market. Much better than hiring a team. Or most probably, they already have a team. So now CISO has the Little Thinking Mind team based in Jordan, I guess.
And it's relatively a big team.
In Saudi, does anyone know if Little Thinking Minds operates in Saudi, the UAE, or has good contracts?
They operate in Jordan, Saudi, Egypt, Qatar. They mentioned 10 countries, but on the map they have on their websites, I think I saw 5 countries, including Saudi.
Yeah. I think it's a steal.
What's the downside, But what's the downside, right? Like, if they raised 170, imagine, I don't know, they're valued at like $500 million, maybe $1 billion. You're paying 10 million for this. That's like, as Tambi mentioned, it's not going to move the needle.
The content library will probably pay for the acquisition itself.
Yeah.
Like, if you were to just sell it, like there'd be lots of people around that can just buy that.
Also, not to beat on this point, but also to keep talking. But if you think about like when Uber acquired Careem, sometimes if CISO wants to go public, they just want to show that they have presence in the Middle East that can give them a valuation premium. Even if they decide not to do anything with Little Thinking Minds and keep it operating and subsidize it with maybe 1 or 2 million a year, just to show that they have presence in that market, that can pay for itself. Yeah.
I love how everyone thinks differently and everyone brings a different point. Like, just very quickly before we move to the next story. It's been a very long journey, 21 years. Kudos to the team. They were really persistent. They have only raised like around $2 million in total over those 20 years. They hired a relatively big team, expanded to multiple countries, and they've survived for 20 years. I'm assuming they were profitable and kept bootstrapping while growing very slowly. As you both mentioned, Saad and Faris, it's not a very high scale business. It's an example of a company that didn't go that typical VC route where you go big or go home. Are VCs in our region willing to invest in such companies or not? Quick reactions.
No, it's just fun dynamics. If you had like maybe like a continuation fund or some sort of evergreen fund, then I think that makes a lot of sense, but not necessarily with limited time as a constraint.
I agree. Not only it's not only time, it's just the dynamic of that kind of company. But I'm assuming that EdTech funds have a long divestment period.
And what do VCs usually do when they invest in a company that they think will be high scale, high growth company, and it doesn't? What happens then?
That's where character comes in.
Yeah.
That's where the type of GP who invested in you starts to matter. That's where that's where the true colors emerge, I think.
Can you elaborate on that? What exactly that means?
That's where you start to know if you have an asshole as a VC or if you have a good person, and vice versa, by the way. And you as a founder, the expectations you set. Did you set the expectations that you'll be high growth? Did you get greedy and raise at a seed round of, 30 million valuation and set the expectation that you will 2x every year? then yeah, you're going to get a slap on the wrist. And vice versa. Are you being an asshole as an investor? Did the founder really give it their best chance or not? So I think, but good times don't test people's character. That's we've learned that lesson before. It's actually when everything goes south that people's character starts to emerge, and you've got investors who are nice and you've got investors who aren't nice, and it's more nuanced than that. It depends on the company and how the founders react, right? So if something doesn't go as planned, unfortunate. Have you done your risk management as a GP to ensure that you have a nice portfolio construction whereby you're able to generate returns elsewhere? Great. If not, does that deal throw your vintage down the basket and you've got to work on other vintages that you've raised for other funds to make up your upside? I mean, there's no straightforward answer. Even the best VCs in the world have substantially differing returns depending on vintage, right? So, and we have to know this asset class is not an asset class that overperforms the market.
It's a good way for our next story, Jamie, with Mantra, because VCs from this region invested $10 million in this company, and it suddenly collapsed. We'll talk more about this after Jamie briefs us with the news. Jamie?
Yeah, a good old-fashioned crypto crash. Nothing gets the blood flowing quite like that, especially with a regional flavor to it as well. So yeah, I've been following this pretty closely. It's an interesting one, and look, it's one of those things with crypto and Web3. It always seems like there's more than meets the eye, and it's difficult on one level really to get to the bottom of exactly what's transpired here. But I'll try to provide my best overview of the current state of play. So Mantra, as you mentioned, Ahmad, backed by Jalouqa, Dubai-based VC. It's a tokenized asset platform. 2 weeks ago, it saw its token drop over 90% in 24 hours. So it went from trading at $6.30 to under 55 cents. So a loss of more
But
than
the
$6
maximum,
billion.
by the way, was $8.5, around $8.5. So
yeah,
it's even more.
It's crazy. It's a loss of more than $6 billion in market cap. And yeah, look, the timing was unfortunate. Only the week before it announced a $108 million fund to back other startups globally. And look, it's only months after they announced a $1 billion deal with DMAC as well, the Dubai-based property developer. They just secured a DeFi license from Vara in Dubai as well. And last year they raised an $11 million round from Jalouqa as well, which they led. So for context about Mantra, who Mantra is as well, would be helpful. So they're a layer one blockchain, so focused on real world assets. So essentially built to help developers tokenize and manage things like real estate, private credit, other off-chain assets. So just using like secure, compliant infrastructure. In terms of, I guess, why this has happened, initial fears obviously always point to a rug pull, and someone has done something untoward. But the data seems to suggest that it's a bit more complex than that, and it's a situation whereby you have a cascade of liquidations triggered by large sell orders in the kind of futures market, so as opposed to the spot market. So it looks like it was something like a $1 million sale on Binance, perhaps like kicked off a chain reaction, and then over $14 million in long positions were liquidated in 1 minute. So everything kind of tumbled from there. So it doesn't seem like there's no smoking gun. Core issue may just be leverage, like illiquidity and poor risk controls at the end of the day.
I don't know about that, Jamie. I don't know about that, because I read in other articles that what really triggered that is Binance when they reduced the loan to value of the OM tokens, the Mantra tokens, from 65% to 40%, suggesting that the risk team and Binance had some concerns about the token. And 2 days later, all this happened. I don't know if this is
I know
directly
the story well, and I'll tell you why. I'm GP at a crypto hedge fund. Been in crypto for a long time, and I'm close to the Mantra story, and we were meant to invest in Mantra. The low and short is 90% of circulating supply that was unlocked was controlled by the founders, which means, usually you have locked tokens, and the locked tokens kind of vest over time. And these VC locked tokens are generally not as favorited by the market, meaning the market likes high float businesses because a lot of rug pulls have happened. So what the Mantra team did was they artificially, pretended like these tokens were unlocked, but the team was in control of most circulating supply. One of the founders broke that gentleman agreement and decided to cash out. And it's as simple as that. And what had happened was a lot of these tokens were hedged with perpetual futures. And so you started to have a cascading effect when the founder transferred his tokens to start liquidating. Of course, you could try to do that with an OTC desk, but probably the amount of tokens he had would have triggered all kinds of warnings. And then people track on-chain wallets. When you see that much mantra being moved, you're going to try and front run that. And once you try to front run that, the algos start to kick in, and Binance Risk Engine starts to kick in and say, look, the collateral required for something like mantra is going to have to change. I don't think it was triggered by Binance. I think it was just the founder here broke a gentleman's agreement and cashed out.
I mean, one of the co-founders.
Yeah, he's still here. I mean, Damak didn't invest. At some point, Shuruq had about $400 million worth of mantra tokens that they bought at 2 or 3 cents, and it went up to 8. So probably more even, I think. So they're still very well in the money here, and at least 20x up. I think their tokens are still locked. So TBD. The good thing about shitcoins is they can go down 90% after they've gone down 90%. So they can keep going down. There's no fundamentals to drive this business up.
Okay, Faris, and crypto or and blockchain in general, the assumption is when it comes to managing not cap tables, in this case those cryptos, everything should be controlled by smart contracts. So a co-founder cannot really sell that easily, right? There should be protocols to prevent someone from doing that, right?
Exactly.
Where are those protocols?
So that's exactly it, right? When you have a project with locked tokens, you can verify that on contract. What Mantra chose to do is not lock those up, so that optically it looks like it's a healthy business, meaning they have high valuation to FDV, fully diluted valuation. People look at it and say, this is not too bad. It's not like only 10% of tokens are circulating, a substantial amount circulating, but they had a gentleman's agreement not to sell. So that way you can optically make it seem like it's a liquid kind of token, but you're artificially locking up 90% of the supply by having a gentleman's agreement. And you're exactly right, is what ended up happening is when you depend on someone to, and not a smart contract, it's game theory at some point. At any given moment, any one of those founders could have done the same thing, or anyone else who has that supply. And so, people get greedy.
Tambi, to follow up on the question I asked before we get to this news about the support of the VCs and how they react to such news. In an interview with the founder, the main founder, the CEO, Mullen, he said there are no plans for him to step down. Shuruq backs, I'm quoting, Shuruq backs founders until they stop trying, he said, quoting Shane Shin from Shuruq. And he's not quitting. He said he's not quitting. How much do investors help in such situations? Are they just supported observers, or do they do something else?
I think they are. They need to be dependable, as Faris said before. If your investors are gonna just throw everything on you, blame you, and then act like that wasn't not me. I don't believe that's sustainable. I don't believe that builds a solid brand for the VC. So everyone starts taking their money instead of other people's money. And I think Shuruq have been on both sides, and sometimes there have been multiple incidents with Shuruq companies, let's say. But at the same time, I think that probably comes because they've been daring to do things that are different. So if you're always de-risking and always just playing, never dipping your toes in something that's dangerous, then you're probably not gonna do good returns. You're not gonna work with interesting people. So I think that's why their name came up multiple times without mentioning all the stories, but they are backing them. Yani they're not. Yeah, from what I heard online and so, it seems like Shuruq are backing them. Like these guys are legit. This is not a rug pull. Something happened exactly like Faris mentioned. And it's more in the nature of crypto, I would say. You know me, Ahmad. I'm not a big fan of crypto, regardless of how good it is, because the nature doesn't really allow. There's too much risk in the management part. I know that we always say like it's boring to be domiciled in a jurisdiction where they control everything and everything is slow. I'd rather have things so move fast and break things on the product level, on the technology level, but on the governance level, move slow. You don't need to like within a few seconds sell everything and put someone else in charge. And doesn't really need to happen that fast. I don't believe anyone complained that I can't do something in ADGM. It's usually you wait for 2-3 weeks. Doesn't really matter. So, in my opinion, these things are a byproduct of that governance model that doesn't exist.
But there's Vera in Dubai, and these companies are regulated. Binance is regulated in Dubai. Mantra is regulated in Dubai, and they're headquartered in Dubai. So there is some kind of regulation, but those regulations or regulators couldn't prevent this. But yeah, maybe because it's the nature of business.
I'm learning, by the way. I really do not understand. You all probably have a better understanding. How did this happen? Faris, sorry to.
Yeah, look, VARA as a regulator, I don't, there's nothing, my view is there's nothing illegal that happened here based on the information that I have, right? So technically speaking, a founder selling unlocked tokens but breaking a gentleman's agreement is not in breach of regulatory frameworks and is not, that's. Having said that, the regulator is there to protect the customer. So insofar as even if something is not directly in breach of a contractual agreement that may not have existed between the founders, if you are a bad faith actor, then it falls under a jurisdiction, that jurisdiction's oversight. And VAR is a very serious regulatory body. I know these guys. These guys are very serious about what they do. They've taken a very clear decision that Dubai is going to be the hub of crypto, and they're taking the responsibility of ensuring oversight. And they've taken action against entities that have violated that and have fined them and have also, done what they need to do there. So it's a very effective regulatory body. But things take time to unfold. As Tambi said, you don't move fast and break things, not as a regulator either. They're not going to come out in one day and say, okay, they take their time with their investigation. They've got to sit with the right people. They need to understand what happened. People have lost money here. So the regulator, I trust that they are taking this very seriously. They've got the competence to do what they need to do. And at the end of the day, it's a nuanced situation. They have to decide what falls under their jurisdiction. If there were breaches, how did those materialize? And then they have to come out with a way to make very clear that the situation needs to be reprimanded 1, 2, 3, and we've seen this before, right? So you've had hacks before. You've had a hack on exchanges like Rain here in the region, and the Bahraini regulator stepped in and said, you've got to make them whole, and some investors had to jump in and do that. So this will happen, I think. As a centralized exchange, being regulated as a broker-dealer or custodian or whatnot is a bit more straightforward, because those frameworks are an evolution of traditional kind of banking, broker-dealer frameworks, whatnot. When it comes to smart contracts, protocols, that unprecedented. Like VARA is at the forefront of this. So you've got to cut them some slack in being able to navigate this and understanding what was the breach and where was it. Again, my knowledge is this was a gentleman's agreement. How do you enforce something like that if there was bad faith, right? I don't know. Maybe they'll learn from it and in the future say no gentleman's agreements, no dumping.
Everything has to be documented and
maybe VARA, one thing that would be interesting for VARA to do is come out and say, okay, fine, we learned the lesson from this. If you want to be regulated by VARA, you have to declare who owns more than X supply of a token as a direct, a UBO, because you could have multiple wallets, and you could say you've got to declare who owns, like, the way UBO works in certain jurisdictions. If you own above 10%, you've got to declare who the UBO is. They might do the same here and declare that, which wallets those are. And you've got to have a note on your website or something in the smart contract that says, these people own this much of unlocked tokens that is directly or indirectly in their control. Maybe that's what they'll come up with. I don't know.
Okay, Saad,
Mm-hmm.
it seems that it's not a hack, it's not a technical issue. The product
Mm-hmm.
is still there. The company fundamentally is still okay. Do you think Mantra can survive this or come back from it all?
I think they can. They will definitely try, I think, but these kind of events do hit confidence very, very hard. But we've seen worse things happen in the blockchain space, and companies have recovered. So I wouldn't write it off just yet, especially if the fundamentals are okay and they've got like a real business behind this. So beyond that, I think what's really sort of interesting is that there's no real sort of like, so I look at sort of like coins as basically a security, and you're basically like, because you've got liquidity on Binance, it's an exchange. So effectively you've almost kind of done like an IPO or whatnot. And so there's no specific, you're kind of following like lockup period rules through a gentleman's agreement, but there's no real sort of mechanism to enforce that gentleman's agreement to an extent. And I'm sure there can be through the smart contract. But then I think the one thing that regulators generally have to sort of make sure that there's good enough disclosure statements, like Far said. But also I think, potentially you have to treat this business, because it's so interconnected with futures, with effectively liquidity, with like risk requirements, like you said, Ahmed, as well, around Binance's risk team sort of, structuring out stuff, that you need almost like capital adequacy ratio kind of being measured, where it's like a public float adequacy ratio, or like, or basically to figure out like how much of the supply is really has like a contagion risk, if it's under the control of one person or two persons or three persons or whatever, right? So just having those sort of mechanisms in place, and maybe, we need to start looking at circuit breakers to an extent, well, when things like these happen. So that would be how I would sort of look at charting a path forward. And I think if Mantra can be at the forefront of basically making sure that whatever has happened doesn't happen again on a systemic sort of level, and they actually put in the risk controls in place to make sure that nothing like this ever happens again, and they measure the risk objectively and much more efficiently in the future.
Okay, Jamie, what's up next?
Yeah, okay. Let's talk about Fluent Ventures then. San Francisco-based early-stage fund. They've raised $40 million to double down on something they're calling geographic alpha. So its thesis centers on the idea that the most successful startups in emerging markets aren't always inventing something new. They're obviously often relocalizing proven Western models, be it your Stripe, Amazon, Chime, and then building them from the ground up with local realities in mind. And look, I don't think Fluent are alone in this line of thinking. I think it's something that we've seen locally in the MENA region. Even, I don't know, Class 5 Global comes to mind to a certain extent, who have also backed BRICS, interestingly enough, which is Fluent's MENA-based play, the Saudi-based construction marketplace. And Class 5 have also backed like Invigo, Zena, and Nomad Homes as well. And I suppose all of them kind of take inspiration from global blueprints and re-engineered to a certain extent to fit regional behaviors and infrastructure gaps and regulatory nuance. So look, in terms of Fluent's founder, Alex, who Saad, you might be able to shed more light on Alex, but he's insisting it's not a copy and paste, that they're filtering hard for local product market fit and founder market alignment, and they've already seen results. So portfolio companies obviously already highlighted BRICS in Saudi, you've Sabi in Nigeria, Minu in Mexico, have all raised significant follow-ons already, and they're going to be very geographically dispersed in terms of deployment. Like they've LATAM, Africa, SEA, MENA, selective US bets as well. For context, Alex previously backed Chime and Z Business, and I think he claims collective portfolios have driven something like $30 billion in enterprise value with multiple unicorns. And look, a plug here as well for our friend Timothy Mott and his newsletter, The Realistic Optimist. If you haven't read it, look, this is a thesis that I think he's been plugging away at now for quite some time. I think he's one of the most thoughtful voices in terms of tracking how these models get remixed and remade across emerging markets. So, Timothy, there you go.
Okay, Saad, let me start with you since you know Alex. So, Alex says that he is a contrarian by heart. And for him, being a contrarian is basically not investing in Silicon Valley, but looking for outside innovation, looking at emerging markets. But the problem that I have with this model is basically we're in 2025 and people are still looking at emerging markets as a copycat opportunity. Is this a reality we have to live with forever?
Well, I think the way kind of Alex sort of so I'll give you a little bit of background around Alex to sort of like set a flavor for how he thinks. So he's American born but Canadian raised. So he sort of come from like Silicon Valley, but been in sort of like tossed salad of Canada. So I kind of share that with him. I'm Pakistani born and Canadian raised, but fundamentally, the way kind of Alex has seen his angel investing happen, and full disclosure, Alex actually introduced us to DealCart, which is a super app built on social commerce and fintech that actually Timothy also covered.
Yeah.
But fundamentally, the way he's seen things is that there's some base case fundamental sort of actions that humanity takes, right? So buying something requires some level of a two-sided marketplace, or effectively having like a digital storefront, or different means of distribution end up creating better operating leverage for you to sort of generate returns on. And that could be like a social commerce model that ended up being really, really good for China. So you look at Pinduoduo, that's how they've been able to scale to such a huge extent. Temu at the same time does a lot of different things which are very social commerce oriented, learning from Pinduoduo. And so if you think about like Alex, he invested into Pinduoduo, he invested into Facility, and then he invested into DealCart from his angel check. And all three kind of share that sort of social commerce edge around distribution efficiency. So, but if you think about all those businesses, they have very different ways in which they were able to effectively build up their market share. They were able to sort of extract revenue from users, etc. They had very different ways. DealCart or Facility, for example, like Facility actually didn't concentrate as much on like infrastructure from a fulfillment efficiency perspective. They pretty much focused on a distribution efficiency perspective. Pinduoduo did both, and that's why they succeeded really like the way they did. And plus, China had such a great third-party logistics sort of infrastructure already that they didn't really have to build any of that. And plus, card penetration is so high, and like digital payments penetration is so high, they had a natural float, right, of a week between like receiving the payment and effectively supplying the customer, or paying the suppliers while still delivering the parcels to effectively the customers. But if you look at DealCart, we had to do something very different. We looked at it and we said, look, we actually don't have a very good third-party logistics ecosystem. We don't necessarily, and for something like grocery, you need actually batch-based deliveries and all of these sort of things. So you have to basically localize the model enough so that it's next day delivery, but it's individual delivery versus like a group takeaway or a group sort of collection point basis, right? And so a lot of these models have to be actually localized a lot more than what people think. But the baseline requirement is that you're solving effectively a fundamental problem or a fundamental sort of pain point, which is common to humanity. And then you're trying to figure out the different nuances and the quirks around implementing the business model. And I think that's what Alex is trying to get at, versus saying that, oh, no, you have to be a copycat. No, he's basically saying that there's fundamental problems that you have to solve. And those fundamental problems have different ways to solve them, but those problems should fundamentally be the ones you are solving in every ecosystem.
Makes sense. Tambi, what do you think?
I think it works as a venture capital firm. Depends on what they're trying to do, but if they're trying to be investors in very large companies that will attract a lot of VC funding in, let's say, Saudi, Egypt, maybe the UAE, I'm not sure, then it's probably gonna work. It's not gonna change the world. It's not gonna be, it's just gonna be like, hey, today we have this in our country. Yeah, it is as it is. It's non-contrarian. It's just doing the reseller model. Like, someone built something, let's sell it in our country as well, or in a different geography, and it will work. It will attract capital. It's weird. I don't know Alex and the guys. I'm sure they're amazing, but it's one of those stories that, it's just meh, in my opinion.
Saad, let me get back to you. You mentioned that it's Alex did this in his angel investments, and now he raised this $40 million from other angels, right? From the unicorn founders. It's not a big amount to take those companies from pre-seed or seed to exit. It's a very small amount and very wide geography. Like they're almost in all emerging markets. I don't know if that's enough. I mean, Tambi mentioned that those companies might attract venture capital, but still, it's not really enough.
The thing is that you've got to basically, if you look at how emerging market VCs actually invest, they invest in packs. They don't really invest individually. So there's not a lot of contrarian behavior anyway. Fundamentally, if you really think about your investing strategy, it has to. So he's taking away business model risk to an extent. He's taking away, probably to an extent, your market risk as well, because it may be just that, there's a large enough market already there, and it's fundamentally proven that these markets are always going to be large, as long as you have like 50 million plus people in a country. But or you have a high GDP per capita, right? The combination of two, but basically it's, like if you can do 300 to 400 billion plus in GDP a year, you're basically going to be able to build something like this from a very interesting perspective. Okay. But he's not looking out for funding risk for sure. The only thing that he's the thing that he will run into is this has been our experience investing in very frontier markets, and all of these markets, all emerging markets are cyclical. There's always going to be liquidity constraints. So if you're not underwriting a path to profitability or default to live, and you are not willing to put in enough follow-on capital to be able to support and get a company to effectively that sort of point where they are at their peak efficiency level to then absorb capital post building infrastructure, you are not going to be able to really sort of execute end to end. So unless you're like a very big fund with or multi-fund or with like a crossover fund or like a multi-strategy fund where you can take over the growth equity part as well, and then like potentially the middle market PE pre-IPO part, and then you can fundamentally sort of from then on sort of pass the risk to the public market or acquirers. Emerging markets need that consistency of capital that you as an institution have to put in and be ready to sort of measure that risk and understand how much capital is needed in order to get you out of that sort of value of debt scenario.
Yeah, that's exactly my concern. I love how you put it. He might not be taking into account the funding risk for these companies, the full-on, unless he's planning to raise a bigger fund later on to invest in his portfolio companies. Faris, let's end with you. Reactions, comments on this?
Well, look, I don't think there's anything additional to add than what was mentioned. Neutral about the strategy, more inclined to be in line with what you mentioned. Yeah, and we can, 40 million can barely get you anywhere investing in Saudi. So how are you going to do it globally? Or any other market at that. I also have my own personal views on post October 7th foreigners coming and investing in our markets, but I'll keep those to myself.
Okay, great. Well, before we wrap up, a big thanks to Octa for sponsoring today's episode.
Yes, if you want to get paid faster, access financing, and automate your receivable process, head to weareocta.com. That is weareocta.com, and take control of your accounts receivable today.
With this, thank you so much, Tambi, Saad, and Faris for joining us today. We would love to see you soon.
Amazing.
This is really fun. Thanks so much, guys.